Good morning, traders. Welcome to the live stream. My name is Charles Gough. I come from a community called Pirate Traders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. So if you have any questions this morning for me on anything that you see on the screen, or really anything at all that you want to ask, jump into the chat on the live stream and let me know your questions. Okay, that's what I'm here for. I'm happy to clear up any gaps in your knowledge, as well as try to help guide you on what the market might do today and even this week. If you're watching this on the YouTube, you're going to jump into the comment section. Well, first you're going to smash the thumbs up button and give me that like. Then you're going to jump into the comment section. Let me know your questions. If you're watching this on the Discord, on the Bookmap Discord, you're going to want to head to the English Traders Floor. That's where you can leave me your questions, comments, concerns, and criticisms. All right, let's jump into the TA. Well, what we're looking at here on the chart is just an absolute mess. I'm going to go ahead and just pull my market profile chart over here a little bit so that you can get a clearer image of what's been going on. So clearly you can see there is no momentum in the market, right? What is the market doing? What has it been doing for months now? It's just been chopping around. It's basically been chopping around the all-time highs, just grinding and grinding and grinding and trying to decide what it's going to do next. Now we've got, war in Iran, adding even more confusion and chaos. So if we look at last week, there was a lot that happened that was very unusual, and I'm going to do my best to make sense of it right now from a standpoint of technical analysis and understanding what is going on with the market. So we had bearish momentum. The market was going down. Okay. Now you could give whatever reasons you want to give for why the market has bearish momentum, but we had lower lows and lower highs for days and days in a row, and the market was working its way lower. And then Trump made the announcement that the war was going to end soon. He said that the war was coming to an end soon. And the market at that moment completely changed. We had what we call a change in the market, where some sort of fundamental information, something that's happening in the world, changes traders' minds and they start to change their positioning. And so that day, the market stopped this downward momentum that it had prior to that. Okay. And it turned around and it started to move higher. And it was just a reaction to Trump's statements. So it was very emotional. When we came up on this particular day, on the 9th, we just came up so fast. Boom, 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 boom. And then we closed near the highs. So what did that mean? What was the market telling us at that moment? It was telling us we had a change in the market. The downward momentum was over, and that the market needed to figure out what it's going to do next. Okay? There's two ways the market can do that. If it has momentum up, it can either go sideways at a higher price for however long it has to go sideways before it decides what comes next, or it has to retrace with price. Okay, it has to come back down. So what the market ended up doing last week was, first it spent a day trying to balance with time. That wasn't enough. So then it started to balance off with price. But we didn't really fully backfill those single prints on that second day where we started to backfill. So we needed another push lower to fully backfill those. Well, that next morning, the market opened with a gap down, a big old gap down. So what did that do? That cleaned up the old single prints. That said, okay, we can take the entire emotional reaction that the market is having, right? All of this excitement over the fact that Trump is saying that the war is going to come to an end quickly. And we can say we've erased all of that. That was just an emotional reaction. So now from this day, which was Thursday of last week, now what does the market do from here, right? Does it keep the pressure going to the downside, getting back to what we were doing before, or does the market turn around and start to head back up? So then what did it do? It kept the pressure going to the downside. So that tells us, okay, things are bearish once again. Things are starting to build momentum down. We had a gap down that became a gap and go. We even closed at the low of the day with a spike down. That's a sign the momentum is going to continue lower the next day. Well, then what did the market do on Friday? First, it poked above the high. So first it confused everyone. Like, wait a second, what the heck is going on here? Everything is bearish. All the momentum is down. We had a gap down and a spike down. This market should be going lower today. But first, they poked up just to sweep the order books, just to take out all the sellers. And then what did they do? Turned around and went right back down. They went right to where we expected them to go. We expected them to go down below Thursday's lows. That's exactly what they did. Once they got down there, what did they do? They just went sideways at lower prices. That's very bearish and tells us the market is going to continue lower. Even at the very end of the day, this isn't technically a spike down, but very close to ending the day with a spike down, which would be the most bearish signal the market could give us. So we're going into the close on Friday and everything looks bearish. Look above and fail of Thursday's high, momentum to the downside, spending time and bringing in volume at the lows, spike down, everything is bearish. So why the heck are we opening this morning with a gap up? If everything was bearish, we should be opening with a gap down or at the very least inside Friday's range. Well, this brings me back to the conversation about these single prints right here. And that really what's going on right now is just indecision. That's all it is. The market just doesn't know how to react. It didn't really want to go lower when we came down here the first time. It didn't really want to keep going down. It was looking for any excuse to stop that momentum down. And that, Trump saying that the war was going to be over soon was that excuse. And then they tried to build momentum up, but they just couldn't do it. So they came back down again. But again, there really was no desire to take the market lower. So what do we do again? Came back up again. So the way I see the market right now is that we are in balance, which means there is no momentum up or down. The market is just going sideways. And I would draw that balance area as basically being from last week's highs to last week's lows, okay, for regular trading hours. This is our balance area. And so if last week, if Friday, we tested those balance area lows, what are we likely to do this week if we didn't keep going down? Turn around and head back up for those highs. So I am now thinking the target for today is going to be, somewhere around 67.79. Okay, we got this VPOC right here. I think this is where the market wants to go today. And I think in the days ahead, this week, we're going to head back up here. We're going to head back up for 68.30 and 68.52. And then we'll see what happens when we get up there. We could, just as easily run out of steam and come right back down. But I do think the market wants to head up and test these areas this week. So if I'm, as an intraday trader today, I'm trying to look for trades that I can take today based off of my thesis. What are the trades that I can take? Well, first and foremost, the gap, and this is going to get confusing because it's a gap inside of a gap. This is the gap down from last week, and we now have a gap up, which is the exact same gap, okay? So just hear me out. Both of these gaps now have a high probability of filling intraday today, meaning the intraday daily market is likely to go to 67.50. It is also likely to go to 67.38. Which of the two it'll go to first when the opening bell rings, I don't know. But depending on which of the two, we will get an idea of what is going to happen next. So if the market goes to 67.50 first, and it starts to get resistance there, as it has been in the overnight, getting resistance there, well, then we'll look for it to turn around and head back down to 38. Okay? If it does not get resistance there, then we'll look to get above the overnight high. Now, we still got another 20 minutes in the overnight, so we don't know what the overnight high is yet. But let's say, hypothetically, it was 67.54. The idea is we push into 50. If we don't get resistance, we look to get above 54. If we don't get resistance there, and especially if we start to turn that into support, then we're bullish for continuation higher. So I could look for a trade from the overnight high, targeting a move up to 67.79 or 67.83. Okay. That's one trade that I could take. So how do I get in that trade? The market opens. It immediately pushes above the overnight high. and it finds support above the overnight high. That gets me long. Those are my targets. Okay. Now, let's say the market starts to push into that previous day's range and it doesn't find support up there. Instead, it finds resistance like we are right now, right? The market pushes up and then starts to come back down. Well, I could get short somewhere around 67.50, targeting the gap fill for today's gap, right? To come back to Friday's high, which is 67.38. So what I would do whenever I felt confident that the market was getting resistance and that we needed a pullback to the previous day's high is I would go short. I'd put my stop above whatever is the high of the day prior to that. And my target would be 67.38, right? For the gap fill trade. Now, same thing we talked about with potential resistance around this low, we have potential support around this high. If we fill the gap that we're creating today, getting back down to 67.38, and we start to find support there, well, that's a bullish. That's a sign the market is heading higher. Okay. If we push back down into yesterday's range, Friday's range, and we don't find support there, we start to spend time and bring in volume, that is bearish. It's a sign we need to start to retrace Friday's range. Okay. So it's going to be a little bit tricky here while we're in the middle of the two gaps. While we're in between the low from the 11th and the high from the 13th, it's going to be a little tricky. But bottom line, if we can't turn the high into support, we're going to retrace. We're going to head lower. And if we can turn the overnight high into support, we're going to go much higher. So we may have to diddle in the middle a little bit here. We may have to chop around. There may be a few fake outs where it looks like it's going to go higher and then it reverses. Looks like it's going to go lower, then it reverses. There may be some games that get played here, but we can trade based on which way we break. Okay. And as I said, for me, bigger picture, what my guess is that if we push into yesterday's range, we will not spend a lot of time in there. We will not bring in a lot of volume. We will just bounce up and out of there. Okay. So if I see that happening, I'm ready to get bullish real quick because I think ultimately, as I said, we're heading back up to the opposite end of this balance area. Okay. And that's this week. That's not today, but over the next few days, I think that's where we're going. Any questions on any of that from the chat? Hopefully you guys could hear my microphone the whole time. Any questions? Gap inside a gap. Laura is here. Tom in the house. He says, it's going down. Panic. Not yet. It's going higher, but yeah. Yep. That's the market we got right now. We talked, I waxed poetic on this a while back. We just get these moments. When you look at the daily chart, you can see that they are just a thing that happens, right? That there are just certain moments in time where the market gets itself stuck in these places where things get really wacky and confusing and they're all over the place for a little while. And it's like, what the heck is going on here? And it's deeply frustrating, right? Like these areas, they happen. Okay. But what always ends up happening once we get away from these areas? Momentum, right? You always get big moves with lots of opportunities where things are super easy once you break out of these sort of range-bound markets, okay? And so we're in a tricky one right now. This entire time, this entire year, really the last 3 months has been a tricky one. But that's okay because the market will find its low and it'll turn around and it'll start pumping higher at some point and things will get much easier for day traders once they do. When we're in these type of confusing environments, the best thing to do is to just focus on protecting your capital. Don't force trades. You don't have to get in a trade. There's no reason you have to take any trades at all today if you don't have a good, clear edge. And if you can do that every day, just only take trades when you have a good edge, then you can get through these periods without, losing a bunch of capital. And you got to remember, there's two types of capital. There's your actual capital, the dollars you have in the bank for trading, your risk capital, and then there's your mental capital, right? That's your psychological well-being and your ability to interact with the market, in a controlled manner. And both of those things, You can disappear them quick if you're over trading in confusing markets. So keep that in mind. Yeah, so basically, just looking at the daily chart here, essentially what I'm predicting for this, the next few days is a chart right here that ends up looking something like this one over here. Just lots of big reversals, lots of confusion, but eventually you'll break out and then you'll get your good momentum and your new all-time highs and the world's amazing again. It'll happen, I promise. It's just right now we're going to be in the mess of it. Jay in the house, he says, traders, life is good. On a rollover Monday, Friday quant witching, and the Fed meeting on Wednesday. Oh, man. So much. So much is happening. Well, that explains it then. That's what it is. It's the rollover. Bum, ba, da, ba, dum, bum, 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 bum. Okay. Let me do this. What's the letter for the new contract? Somebody help me out in the chat. We're leaving H and we're going to, is it M? Exploring CME in the house. Good morning to you. Will is here. Michael is with us. Trevor in the house. Chester. Al says NQ. Yeah, we'll take a look in just 1 minute. M. M's what it is. Okay. So what I'll be doing throughout the day today is I'll be clicking back and forth between the two contracts, between the ESH and the ESM contract, because liquidity, especially on day one of the rollover, will be slightly different on both of them. So we don't have a choice. We just got to watch both and see what's happening with the liquidity on both contracts and look for how things change. As far as price action is concerned, as far as the actual levels on the chart I'll be referring to, I'll be on the M contract. Good morning to Trader in the Discord. Good to see you. All right, let's take a look at the NQ. So the NQ has been kind of like, pretty much in step with the ES here. A lot of chaos. A lot of balance, just an insane amount of balance. I mean, just look at this for a second. Look at how gnarly that is. Just months and months and months of going sideways. Okay. So same exact thing. Yeah, as far as the NQ is concerned, it's identical to the ES today. So what are we looking at? Well, same thing as the ES. You looked below the previous day, Friday's low, on the weekend, and then we're able to come all the way back above Friday's high, again, because of the contract rollover. So you're back inside the old gap. So it's the same thing, balance inside of balance. We got to wait and see how the market handles the gap to figure out what comes next. So my assumption on the NQ, like longer time frame, is the same as the ES. I think it just wants to be in balance. And the NQ, the balance area, is crystal clear. I mean, you can just see it. Boom, right there. A little bit lower. Right there. So again, that increases the odds in the days ahead, not necessarily today, but in the days ahead, we might be heading as far as 25 to 40 on the Q. And we're just going to wait until the market opens to figure that out. Exploring CME says, Charles, do you prefer using 2 profiles, the overnight and the regular trading hours, or 3 profiles, Asia, London, and regular trading hours? Nope, just the 2. The only reason I can see to split out Asia and London is if you trade those markets specifically. So if you are in Australia and you're trading during different hours, you're trading during Asia's hours, it might make sense to split it out like that. Because what you're looking for is patterns, right? And you're looking for the patterns that happen during whatever hours you're sitting behind the computer, right? So if during those hours, something major happens every single day, like one market opening or another market closing, like when Asia opens or Asia closes, when London opens or London closes, those key moments, they happen every single day. You can look for patterns. What does the first hour of trade in the Asia market look like? What does the last hour of trade look like? How does the London market react to whatever the Asian market did? So for example, if the Asian market was just going sideways, does that increase the odds that the London market will pick a direction and start to trend? Or if the Asian market was trending, does that mean that the London market will keep that trend going or reverse it? Start to recognize those patterns. Whatever time you're sitting in front of the computer screen, what are those patterns that take place over and over again? That gives you a framework. That gives you a what should happen, right? So then you're looking for times where the things that should happen don't. And then when you combine all of that together, the probabilities of repeatable things that should happen, and then knowing the odds are in your favor for the opposite when they don't, and suddenly you have a strategy. So what you see on these charts is what I do. This is it. I have no hidden charts that I trade that people can't see. This is it. What you're seeing on the screen is everything I use to make my decisions all day, every day. And for me, the only thing that really matters are those key levels, which was the overnight high or overnight low. Maybe they made it during the London session. Maybe they made it during the Asian session. I don't really care. I just need to know where that level is. So I combine it all together. Thank you, Al, Elsa, and Tyler. Appreciate you. Any questions? We got 6 minutes till the market opens. So for those of you that are newer to trading or newer to trading futures and you don't understand what a contract rollover is, it's just part of the business. It's just one of these things we got to do, whether we like it or not. And it happens every quarter. You got to roll over to a new contract. Okay. And essentially the way it works is you have 1 week to get out of your old contracts. So if you have a trade on right now on the ESH contract, you have until Friday to take that trade off, to exit that trade. If you're not out of that trade by the end of the day on Friday, your broker is going to automatically close the trade wherever the market is at that moment. Okay. So you have 1 week to get out of your H contract trades, and you've got, at some point during this week, you want to switch over and start trading the M contract, the new contract. The way I do it personally, and everybody kind of has their own opinion, the way that I do it is I just start trading the new contract that day. So if I'm going to open up my brokerage account right now and I'm going to enter a trade, it's going to be on the M, because for me, the data that I'm using over here, I'm using a continuous contract on my market profile, and that just automatically updates to the new contract on the first day. So that's why. Hence why I was so surprised by the major change in price this morning, and why it would make more sense for me to trade the M, because that's what I'm going to be seeing on my screen is the M. A lot of people wait until the Tuesday of this week or Wednesday when there's more liquidity on the M contract versus the H. That's when they'll wait and switch. For me, I don't trade big enough size that it matters, so I can just start trading the M immediately. You will notice there are differences in the actual prices themselves. So on the M contract right now, the current price is 67.46, but on the H it's 67.97, or sorry, 66.97. Okay, so these are very different prices depending on which chart you're looking at. That creates confusion, not just for you when you're trying to figure out where do I put my trades, but for everyone else, right? Everyone on planet Earth is rolling over their contracts on slightly different days for slightly different reasons. And so everybody's looking at slightly different price charts right now. And that leads to a lot more confusion. These weeks, especially the first 3 days, Monday to Wednesday, tends to be a lot of choppy, confusing stuff that happens. It's not necessarily a momentum thing. Like if the market is going up, it's going up. If it's going down, it's going down. It's more just like, where are those support and resistance levels, right? Are they going to hold? They are less likely to hold now because everybody's seeing slightly different numbers and putting their orders at slightly different levels. But I would say by Thursday, everything will be back to normal. And everyone will be on the M contract. Exploring CME. He says, how do you differentiate London and regular trading hour sessions as there is an overlap? I just think about it as regular trading hours. So yes, technically for the first few hours of the regular trading hours, London is still trading, but that doesn't matter to me. I don't care about it. Think about it like this. Okay. The stock market, the American stock market is only open from 9:30 to 4. Okay. I know some brokerages are offering extended hours and blah, 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 but for simplicity's sake, those are the hours that the market is open. So when you're in those hours, 9:30 a.m. to 4 p.m., the market is going to move differently than any time outside of those hours. Okay. Always. Because there is what's called arbitrage bots. So you've got 500 different companies in the S&P 500. And the moment the opening bell rings in 2 minutes, they're all going to do different stuff. Some of those stocks are going to go up. Some are going to go down. Some are going to go nowhere. Right? Some are just going to sit. So there are computer programs that second by second, all day, every day, like every millisecond, are tracking all these moves. And if certain stocks are going up, it is figuring out how much should the index, how much should the S&P go up? If certain stocks are going down, how much should the index go down? And it's arbitraging between, the SPY, the VOO, the SPX, the ES, all of them. There's arbitrage between those underlying shares and the indexes that trade them. Okay. And so that's its own machine that functions all on its own. And it just does its own thing all day, every day. As stocks are going up or down, it's adjusting. It's buying or selling the index. So the best way to think about the market, if you want to make sense, and especially if you want to find patterns, recognizable, repeatable patterns, the best thing that you can do is to separate your time between when that arbitrage mechanism is turned on and when it's not. And during the overnight session, whether it's London or it's Asia or it's whatever, it doesn't matter. During those times when the stock market is closed, the futures just do not move the same. They behave differently. And so you pick, am I going to be a trader that focuses on the time frame that is the US market, or am I the trader that's going to focus on the time frame that is Asia and London? Okay? And that's all you need to think about. Don't worry about who is actually entering trades. You know, the person going long right now might be a trader in London. It might be a trader in, you know, the middle of Africa. It could be a trader anywhere on earth. That doesn't matter. But the time frame of when they're trading, that's what matters. Okay? Because they behave differently during different times. For example, we are now in the first hour of trade. From 9:30 a.m. to 10:30 a.m. every single day, no matter what, the market moves slightly different than it does any other part of the day. It always has what we call an initial balance. Sometimes that is momentum. Sometimes we get like a gap and go and it immediately starts the momentum. But that first hour is going to behave completely differently than the rest of the day. Same thing with the last hour. 3 p.m. to 4 p.m., that hour is going to behave completely differently than the rest of the day. So it doesn't matter who the traders are that are trading during that time. It's about what time it is on the clock. And that's all due to arbitrage. Okay. So the market is open. If you are trading the M contract, this is a gap up. If you're trading the H contract, you're inside the previous day's range. Either way, we're looking for resistance right now. So does the market get resistance and turn around and head back down through the opening price? If it does, we'll look to fill the gap, getting to 67.38. If it does not, we'll look to head to the overnight high, 67.55. Izan says, do you trade during the live stream? Yes, sir. If there is a trade, I will take it. Now, I don't put my trades up on screen for you guys to see. I'm doing it on a separate computer. Because I have found that if I discuss my trades live, then that affects my trades. It adds extra pressure, extra psychological pressure to be right. Because the truth is, I don't mind losing money. I feel no pain. I can get stopped out of a trade and it literally have no reaction whatsoever because I'm so used to it. But I still feel pain every time I'm humiliated for being wrong publicly. There's just something about it. It's more painful to me to be wrong than to be wrong publicly than it is to lose money in a trade. Losing money ain't nothing. I can do that without flinching at all. Okay, so this is a gap and go right now. This is bullish to see. Again, only bullish as long as we stay above the opening price here. If they cross through that opening price, we look for a pullback. Okay, so this is a particular situation that we like to talk about. It's an important nuance. Okay, so the market, obviously we had this big move up in the overnight session. So the market is opening today above positive 1,000 on the tick chart. That's an important nuance. Okay, first off, it's telling us we have bullish momentum, obviously, but it is also telling us that the market needs to relax a little bit, that the market may have gone too far too fast. Now, there's two different ways the market can relax. It can either just go sideways, spending time, and then as it goes sideways, these ticks will cool off and come back down towards the zero line, or it can start to pull back with price, and that can cause the ticks to cool off. But the fact that we are this overbought with the ticks increases the odds that we will need some cooling off time. So if right now we're on a gap and go, what are we thinking? Well, we can definitely get to the overnight high, right? Maybe even the first week reference, but we're probably not going to go much further than that, right? We're probably going to poke up there and then turn around and come right back down. Why? Because those ticks are still so overbought. So this increases the odds in my mind of a look above and fail of the overnight high. But for now, we're looking to test it and see what comes next. Okay, so we got to that overnight high. So we got the gap and go, move to the overnight high. That's bullish to see. This is where we look for the market to start to run out of steam, the momentum to start to run out, and maybe this thing turns around and heads back down. So what are we watching for? Well, we're watching for taper in the volume up here. You see how there's less and less volume at the high up here? You got 5,000 contracts, then 3,000, then 1,600, then 1,000, then 500. Less and less contracts as we go higher. Same thing at the overnight high. 7,000, 6,000, 2,000, 1,700, 1,600, 600, right? So we're looking, does that same thing happen right now, just above this overnight high? Do we taper off less and less and less contracts? The next thing we're asking is, does price turn around and come through the opening price? If you get both those things, you taper off the volume and you cross the open, and you have just made your high. And now the market's looking for a dip. So the first move would be to backfill the gap to 67.38. Now, let's say that doesn't happen. We don't taper off. Well, then we're bullish and we just keep going. Let's say we stay above the opening price. We're bullish and we just keep going. I can tell you, just looking at the liquidity, a lot of the liquidity has already moved to the new contract. Can the buyers hold it? Can they bounce? Rich in the house, good morning to you. Heart Medicine is here. Dan says, hi, love your setup. I love the absorption indicator. Shows me how much absorption is happening on Bookmap. Lots of absorption here. I mean, there's 8 ways to see it, but I like to see it tracked. Yes. There is. Yeah, Bookmap literally gives you like 10 different tools to track absorption if that's what you want to track. Yeah, so what I think you're referring to is this volume pressure imbalance. That might be which one you're referring to. So this to me the way I use this indicator, this is one of my favorite indicators in trading. This is a, hey, Charles, pay attention indicator. That's what this is. So essentially it's reading the volume pressure imbalance. So when a lot of the volume at this exact moment is more long than short, it goes green. When it's more short than long, it goes red. Okay. And if it gets to an extreme reading where it's over 95% one way or another, which obviously is only going to happen during absorption, right? It's only going to happen when you're sweeping the order books and you're taking out stops, right? If that happens, it makes that clicking noise. Click, 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 click. And that tells me, hey, pay attention to the chart, Charles. Something's happening right now. Because you only get a sweep of the order books. You only get to that completely 95% of the liquidity is one way or another at key reversal levels. Now, let's say one of those is right above us right now. We're about to sweep the order books. We're about to see it go positive here in a second. Okay. And what that will be is sellers that are shorting the market right now. They've got their stops above the high. So we'll poke up and we'll take out those stops and you'll hear click, 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 click. You'll hear that noise. So that tells you, okay, we just swept the order books. We just took out all those stops. And then there's only one of two things that happens. You either poke up and take out those stops, bring in new buyers and you keep going, or you poke out, take out those stops and then reverse and start heading lower. So if when you hear that click, click, click noise, you pay attention to the chart at that moment, it's a great time to look for a trade, either a continuation or a failure trade. There it was. You hear it? I was just talking, but it just did the clicks. It did the clicks right as we took out those stops right there at the high. Not that it matters because we're right up against it, but we have a low volume node at 56 that needs to backfill. Good morning to Guillermo. Welcome. Crypto Writer says, are we already on the June contract or still on March? So as I said, my chart automatically updates with a continuous contract. There's a question here from Steven in the Discord where he says, can you go over a continuous contract? Not sure I understand it well. Yeah. So we talked about the fact that there's a different futures contract every quarter. Okay. So it's just a different contract that has a different price level. Why that happens, I don't know. It just has to do with the fact that some people buy future. So some people are going to buy contracts that are expiring in December right now. And so it fucks with the price levels and it gives them all different price levels. But the point is they're all slightly different price levels. Okay. And so you can get what is called a continuous contract. Now, each data provider builds their own continuous contract themselves. Okay, that's just how it works. So they're choosing how to combine those multiple different contracts together. Some of them use like complex mathematical formulas where they literally use like math to combine what is the difference between the two prices. And that's what they give as a price on a continuous. So for example, that's what, if you have this the B adjusted, button right here on the continuous contract on TradingView, you can adjust whether you want it to use its math or not to decide what the differences are. But the continuous contract that I'm using for my IQ feed data provider, the way they work is they just automatically roll over on day one. So simply put, they just automatically rolled over last night. So if my market profile is showing me the M contract, the price levels for the M contract, I'm going to be trading the M. It just makes more sense. But you don't have to. You can roll over tomorrow or the next day or the next day. It's totally fine. But looking at liquidity, it looks like we already have more liquidity on the new contract anyway. So I don't know why you'd keep trading the old one. Now, if you have a trade on in the old one, like a swing trade, you can get out of that for sure. Dan says he's talking about the actual absorption indicator because I can see them accumulating on the way up or down or stopping price altogether. Yeah, I don't use that actual indicator, the absorption. I used to have it on my chart. I just felt it was too much. The problem with TA is if you put too much on your chart, you're trying to keep track of too many different things, then it starts to cause confusion for your mind. You know what I mean? So in order to keep it simple, I use the stops indicator and the icebergs indicator to let me know when large players are doing what they're doing. And then I use the volume dots to recognize imbalances between buyers and sellers. And then I use the volume pressure imbalance, like I said, as that sort of trigger to let me know, hey, Charles, this is a moment where something matters. We're either going to bring in new buyers and keep going, or we're going to fail in reverse. And so that's just my system and how I stack those things together. But there's lots and lots of options, particularly if you start talking about this market pulse right here, this indicator. You can combine like multiple different market pulses together. You can combine a bunch of these things. The sweeps pressure, the spread change, the order book pressure, the pace of the tape, the icebergs pressure, all of this. Like you can take any of these things. You can create a volume, a market pulse for them. So basically this thing, right? Then you can combine those different market pulses together and make a market pulse of that. So you could say, hey, let's combine when we have the sweeps indicator telling us something, with the volume pressure indicator telling us something, with the absorption indicator telling us something. Like, let's combine all three of those together, and then that gives me a signal. I mean, it's really amazing what these tools make possible. But no one person can use them all. One person in their trading intraday each day. It's just too much. So you pick what you like, you pick what works well for you, and you just become really, really good at using those indicators. Okay. So I believe we are at what will be, over the next few weeks, our pin. Okay. So let me just zoom out here and make a case for what I'm talking about. A pin is just essentially a sort of a level that the market, when it tries to get away from that level, it keeps coming back to it. So I'm guessing that this large node at 67.69 is about to become a pin. Okay. And I just watched the way we came into this level here, then reversed and went away, came into it again, then broke lower, came back to it again, then balanced, right? Came back to it again, then broke lower, and now we've just come back to it again. I think this is probably going to be the pin. And so now that we've gotten to it, that might be as far as we're going. And we're ready to turn around and come back down. If we keep going from here, if we get new buying and we keep going, then we can get really, really bullish, as we know the market is in balance at that point. So looking for resistance here. And can they stay above the overnight high? If they pull back down below, the overnight high, they'll probably liquidate through the opening price. So if the buyers want to keep this momentum going, they want to poke through this pin. And we still have a low volume node at 67.56. So if you're looking to trade the market, don't go long at the high. Wait for the pullback to backfill that low volume node. Wait for the support right at that overnight high. Then you get long. You can take on much less risk than by chasing price at the high. Dan says, oh, wow, I'm going to have to play with that. Do play with it and let us know. Let us know what you think. Also, I don't think I'm supposed to talk about this yet. I may be spilling some tea here. I'm not supposed to, but in the future, they're working on right now setting up an automated trading system that can use these market pulses. So essentially, getting to one of these extreme reads can be an automatic trigger to enter a trade. So if you could start playing with them, playing with all the different options, you know what I'm saying? And figure out how to combine. How do we combine, these different settings together? And you can find those opportunities where in that moment where all those things align, it means the market is likely to do this or that. Soon enough, you'll be able to program trades to take place using this same indicator. They're not there yet, but they're working on it. So that'll be very interesting once that comes out. And I have no timeline on when. Black says, no NQ. I'll take a look for you. Yeah, when it comes to NQ, just say something and I'm happy to talk about it. I just often get really focused on ES. Yep, gap and go. Same as the ES. You got the gap up. You pushed above the overnight high. You are currently turning that into support. So I wouldn't say it's confirmed yet. But I would say you are bullish, same as the ES. Bullish as long as you stay above the opening price. They should be able to hold 24,890 as support. And stay above 24,870. They cross back through that opening price and you'll start to flush lower. But for now, it's momentum up, both markets. The buyers are trying. They're trying to take the markets higher. Let's see if they can do it. Only a couple minutes left in the stream today. If you guys have any questions for me, please jump in the chat and let me know. There's a question here. Why do you trade the ES over the NQ? What are the differences in the price action between them? That is a great question. I have tried trading both individually and together. I prefer the ES. My reason for preferring the ES is that its moves are more repeated. So essentially, the NQ is a little more random. It kind of behaves in a little bit more of a random way than the ES. The ES is a little bit more repeatable. Also, the ranges, you know, it's just you have smaller ranges on the ES. So you have less extreme like moves that aren't as big. So essentially a way of saying that is like the NQ will poke up above the overnight high. It'll come back down, it'll tag it, and it'll go way into the overnight range, like deep into the overnight range. And then out of nowhere, boom, shoot up and make a, 30, 40 point move up. Okay. Whereas the ES will poke above, it'll come back down and it'll maybe only go a point or two into the previous day's range. And then it'll go up, but it may only go up, 10 points instead of going up 40 points or 50 points or whatever. And so it's just milder moves. The move back down into the range is less extreme. You know what I mean? So I can trade with tighter stops. I can know I'm wrong much more easily than with the NQ. The NQ will shoot way back into the previous day's range and still end up trending higher. So it's just a little more predictable in that way. And also I don't have to chase trades as much. A lot of times by the time the NQ gives you the signal that it has momentum, it's already made, 10%, 20%, 30% of the move it's going to make. It's done it instantly because it just moves so fast. And so to me, that's much harder. I'm more cautious to enter trades. I'm more afraid to enter trades on the Q. And I'm also chasing trades much more often. Whereas on the ES, I feel more comfortable, so I get in sooner. It's really a tempo thing. It's the speed that it moves. But as far as the market behaviors are concerned, it's exactly the same. The auction process works exactly the same on both markets. So you could decide, and there are many traders in the room here who are NQ traders, you can decide you prefer that faster pace. You like that randomness. You like that speed and that tempo change. You like that volatility. Some people love it. You know what I mean? I just personally don't. I like things to be as slow and controlled and repeatable as possible. And of every chart I've ever studied, the ES is the best at that, at slow, repeatable moves that happen every day. Guillermo says spot gamma. Let's take a quick look. Spot gamma. Oh boy. Okay. Okay, so spot gamma right now, we have overall gamma is red, clearly very red. So again, that leads to more volatility, larger moves, larger ranges. As in a red environment, market makers are buying as price is going up and they're selling as price is going down. So it doesn't mean we can't have a choppy day that goes up and down and up and down. It just means each of those chops is going to go a little further than you think it would. You know, you might push into your first resistance. You think it's going to reverse and come back down. No, actually, it's going to go to your third resistance level, and then it's going to come down. You're just going to have bigger ranges. We can clearly see, particularly looking at the 0DTE gamma, that there's a lot more gamma above price right now than below. That will generally lead to a melt up, right? The market will want to move up to these areas where there's more gamma. None of these levels jump out as like a particularly large level that becomes a target. Like it has to get there. But just seeing that there is more gamma above price than below makes me lean a little bit more towards a drift higher today. And then the one thing that's complicating that is the hero line. So the hero line is, you know, our best way of trying to predict based on purely options market maker data, where is the market going to go next? And that is actually going sideways to lower right now. And we're actually in the negative numbers. We're at negative 1 billion. So that implies that even though price is going up at the moment, the options market on the SPX is gearing up for a move lower. So it kind of reads as balance right now. I would say slow melt up to balance. Okay, so this is the type of thing I love. The market has just given us a good trade setup. Why is it a good trade setup? Because it's based on market generated information. What do we know right now? We know that low volume nodes almost always get backfilled, meaning you create it on the way up. At some point, the market will come back down to that level. We also know that when we have a poor high, the market often first pushes away from the poor high, but that it's not bearish. A market pushing away from a poor high doesn't mean it's going to go down. It just means it's pushing away, looking for discount shoppers, for buyers to turn around and come back up. So if we hold this poor high right now and pull back down to backfill this low volume node, we've got support at the overnight high. We've got a tight stop because we know we want to stay above the opening, right? If we cross through the opening price, we liquidate. So our stop's going to be below the opening price. So if we come back down to the overnight high now, we've got an opportunity where we can take on very little risk and very high probability the trade will work. Because at that point, we have the gap and go as a sign of momentum up. We have time and volume above the overnight high as a sign of momentum up. We have the value area against the high of the day. We have the poor high. We have all these things pulling on price. So if we get a dip where we can get into a long with very little risk, well, the market is doing us a favor. Let's see if it happens. Unfortunately, I've got to say goodbye to everyone here in the Bookmap world. I appreciate you guys. Let me just run through and see if there's any questions I can answer before I leave. There's a question here. Is the Sierra chart TPO default in Sierra? Do you have a video describing your chart setup? I do not. So the market profile chart that I use is from a company called Window Trader. If you wanted to use Window Trader, I can send you a template. Just email me and I'll send you a template that you can literally just open the template and it'll automatically propagate and make it look just like my chart. If you want to use Sierra, in our Discord, in the Pirate Traders Discord, there is a tab that says future software and settings. And there are people that have gone in and made those type of templates for Sierra as well. And they'll give you all the instructions in there. Also, for what it's worth, those of you that are asking about TPOs, that is another thing Bookmap is currently working on. They have a TPO chart in beta right now. So they're working on it. They're making tweaks to it. They're making it better. But hopefully you can just use that. And that way you don't even have to get a second software package. You can just use your Bookmap. That's not quite ready for the public yet, but they're working on it. Dan says, I love the way your TPO chart looks when you zoom in and out and give context. Yes, that is what makes Window Trader unique of all the TPO charts out there. It's just very clean. It's visually very easy to see where those key levels are. TR James says, I'm searching for the ARG sellers and buyers in the add-ons, but I can't find it. What's the name again? Well, if you're asking what I was talking about, it's called the Market Pulse is what this tool is called down here. And then once you have Market Pulse inside the settings, there's all the different options. So, you know, there's indicators that you can put on chart for all of these as well. But if you want to use them in the volume pressure, so that basically just puts it in this thing right here that lets you see, and you can choose your level. So I've chosen 95%, but you can choose it to trigger it any amount you want. Willie also asking about the app on the left. It is called Window Trader. Window spelled without W on the end. Window Trader. All right. With that, I will say goodbye. Thank you guys very, very much. We will see you here next week. Have a great day of trading. As far as I feel right now, obviously it's a little bit early to make a strong call here. I feel like we are going to dip back down to the overnight high right here around 54. If we find support there, I'll be bullish for the day to start trending higher. Okay. If we don't find support there and we cross through the opening price, then probably this is the high of the day. Okay. Because we're going to liquidate if we cross through the opening price, but I don't think that's what's going to happen. I think this market is in balance. And so as we started the stream talking about, I think at some point this week, maybe Wednesday, Thursday, something like that, we're probably going to be up here near the balance area highs. So somewhere between 68.30 and 68.50. And so I think we're starting that move today. That's what everything looks like right now. So we got the low volume node in need of backfilling and the poor high in need of repair. Let's see where we go from here. Thank you very much. Members of the brigade, let's set sail. I will see you in the private stream in 2 minutes.